Today is the 11th of February 2020. My name is David Hickson, and in today's market update I'm going to be speaking about actually trading the FLD, or future line of demarcation. Before we take a look at the markets, please make sure that you have read and understood these disclaimers. In my previous market update, which was recorded early in the day before the US markets opened on the 30th of January, which was that bar over there, I spoke about how I was still expecting the 20-week cycle trough to lie ahead of us. Here is the nest of lows, which is the collection of these circles and whiskers, indicating the time at which we were expecting the 20-week cycle trough to occur. I mentioned several times the date of the 10th of February, which was in fact yesterday, and that was approximately the time that I expected the 20-week cycle trough to occur. I spoke about why I considered this trough over here on Monday the 27th of January to be a little early for that 20-week cycle trough. So what happened? Well, in my opinion, the 20-week cycle trough formed on the very next day, the 31st of January, and we'll zoom in a moment and take a look at the detail. But it does highlight a very important point about working with Hurst cycles. You should never simply set your alarm clock, if you like, and go away and take a holiday because you're expecting the 20-week cycle trough or any other trough to occur on a particular date. These nests of lows, as you can see, are inverted triangles representing a range of time in which we could reasonably expect a trough to occur. In a bullish market, as I have mentioned in previous market updates, and this has certainly been a bullish market, you expect troughs to occur early. So it isn't really a surprise that the 20-week cycle trough probably did occur a little early. Let's zoom in and take a look at the detail of how this trough formed. So the 30th of January, when I recorded my previous market update, was this bar over here. At the time that I recorded this update, the market hadn't moved upwards so strongly. I think that was as a result of Amazon announcing their earnings or something like that. It was a little bit of volatility in the market, and the very next day price came down fairly hard. Now, of course, this was an F category interaction with the FLD, and we generated a target which was, as I think I mentioned in the previous market update, it was fulfilled at that low price on the 27th of January. And so the market, it didn't have to move any further in order to achieve its targets. But of course, there needed to be a little bit of bearishness in the market as it moved down towards the 20-week cycle trough. A 20-week cycle is not an unsubstantial trough. It's about 4.5–5 months long. So you do expect a little bit of bearishness in the market as price moves down to that trough. However, as I mentioned time and again in these market updates, you need to bear in mind the current situation in the market. And this market has been a bullish market. I keep saying it, and there haven't really been any signs that it is turning bearish. There was a slightly bearish indication over here, as I mentioned in the previous market update, where price didn't actually get up to the 20-day FLD, which it is expected to in what we call the G category interaction. And that is, of course, followed by an H category interaction as price moves down towards the 20-week cycle trough. The important thing when you're using Hurst cycles is you have to bear in mind the current state of the market, and this has been a bullish market. And you also need to realize that cycle wavelengths and amplitudes are dynamic. They are constantly changing. And so you certainly never set your alarm for a date such as the 10th of February and then just wait for that date to happen. You have to watch what is happening in the market. So the 20-week cycle trough has formed, in my opinion. It formed a little bit early. It formed about 10 days early, but that is probably the 20-week cycle trough. Now, what makes me think that? Well, one of the reasons that I believe that is the 20-week cycle trough is the way in which prices interacted with the 20-day FLD, this purple line over here, following the formation of that trough. As you can see, price crossed up above the FLD very nicely and strongly, and it has risen straight up and fulfilled its target generated by price crossing up above that FLD. That is not the way in which price behaves in a G category interaction. That is the way in which price behaves in an A category interaction. And so I fairly confidently label that as an A category interaction. Is it still possible that price will come down and form a 20-week cycle trough lying ahead of us? It is still possible, but very unlikely in my opinion. So let's speak a little bit about how one could have actually traded this. I spent a lot of time speaking about the analysis and what we're expecting. I don't dwell a lot on the details of trading, and there's an important reason for that, which I must state right at the outset here, and that is that I believe that trading is a very personal thing. I think that you need to find your trading style, and you trade according to your style. And my style of trading might be very different to your style of trading. And so you need to identify what level of risk you're happy with, what sort of confidence you have in your analysis. Every single trade is slightly different. I think you cannot be absolutely black and white. You need to consider each situation according to its own merits. So with that having been said, let me discuss various ways in which this interaction could have been traded. First of all, on the Friday or over the weekend, we would have looked at this strong move down and said, now possibly price is indeed coming down into the 20-week cycle trough. We are expecting that 20-week cycle trough. It is probably going to occur early because this has been a bullish market, so we should therefore stand by. One approach would be to have entered a long trade as price crossed up above the 20-day FLD. That's the sort of blunt approach. And honestly, it's not an approach that I take very often, because an interesting thing happens very often when you are looking at price forming a fairly big magnitude trough in the market. And that is that things look very undecided. You'll find it happening time and time again, because at this point, on the Monday, for instance, price rose up. As you can see, we had a bit of a green bar, a little bit of bullishness, but it was an inside bar. It traded entirely within Friday's range, and so it wasn't a particularly bullish day. At the end of Monday, looking at this, you would have seen the nest of lows still lying about a week ahead of you. And you might have said to yourself, well, this looks as if the price has come up towards the FLD. That's probably the G category interaction, and now it's going to move down again. And on the next day, when price came up to the level of the FLD, and it actually spent some time at that level before it managed to break up above it, you would have been probably very indecisive. Now, most people look at the sequence of interactions and they identify the A category interaction as being a wonderfully profitable interaction. And indeed it often is, because the A category interaction almost always fulfills its target. And so you can often get really good profitable trades out of an A category interaction. There is a problem, however, and that is that very often when you're entering an A category trade, you are consumed by indecision because of this very situation. You know that you're expecting an early trough, but price is at the FLD. Surely it's going to go down and still form that trough ahead of you. So you're filled with indecision. And that's the kind of thing that often happens at the A category trade. So there are two approaches. One approach is to enter a smaller trade at the level of the FLD. If it turns out to be a G category interaction, you take a small loss. That's one approach. That's not my personal approach, I'm going to tell you right now. The other approach, which is the approach that I take, it's the approach I've taken for years, is that I sit back and I say, oh, that's interesting. An A category interaction has probably formed. I haven't entered a trade. I don't regret that. I can tell you right now, miss most A category interactions. Or at least I miss the trade involved in the A category interaction. And the reason for that is because of the way in which I trade, my personal style. I am actually very happy to miss an A category interaction because it tends to be a trade that is often clouded by confusion. And so I missed the A category interaction. My personal approach, and one I'm going to introduce in this video, is to sit back and wait for the A category interaction to actually happen. I don't jump into a trade. I'm not anxiously thinking, is this right, isn't it right? I simply watch it happening. I wait generally for a day or two, and I look at the way in which price is behaving, and if price looks as though it has indeed crossed that FLD in a strong bullish manner, in other words, this is a good A category interaction, then I consider getting in to the next trade, which is a C category trade. Obviously, I don't go short for the B category interaction as price comes down to the FLD, but I look at getting into the next trade, which is the C category trade. And in the statistics that we ran on many instruments going back over many years and working out the sort of idealized trading results of trading the interaction between price and the FLD, I must tell you that the most profitable trades were the C category trades, not the A category trades on the long side. On the short side, they were F category trades. That's a discussion for another time. But I am very happy to wait for the A category interaction to actually happen. So under that kind of situation, what would I do? Well, one approach is to arm the 20-day FLD, if you like, with a limit trade, not a stop trade order, but a limit trade order. So you say, as price comes down to the 20-day FLD, I will enter into a trade as it touches that FLD. I quite enjoy trading in that manner. It's a fairly aggressive approach, but it's one that generally works. If you're going to do it, you need to make sure that it meets your trading style, given the comments that I made earlier. But now, if you go back over the recent market updates, you will know that recently this market has been jumping up above the 20-day FLD in an A category interaction. And in the B category interactions, when it comes down to the 20-day FLD at round about the time of the first 20-day cycle following the longer cycle trough, you will know that price has failed to actually reach that FLD, which means that if you had a limit order set at the level of that FLD, you simply wouldn't get into the trade. So what do I do? Well, under these circumstances, what I do is I step down and look at a shorter FLD. In this case, the 10-day FLD. So let's display the 10-day FLD. I've managed to turn all of them off. There we go. There is the 10-day FLD. Now, following an interaction that looks very good as an A category interaction, if I've missed the trade, I don't worry. I will often set a limit entry order at the level of the 10-day FLD, which of course moves every day. The 10-day FLD was reached yesterday. It was actually reached before the US markets open. I think I'm correct in saying it happened in overnight trading on Sunday night, and the 10-day FLD was reached, and that provided us with a good limit entry to catch this move. So that is my approach. I don't necessarily catch the A category trade. In some circumstances, of course, I do try to catch it, but in many situations, I actually miss the A category trade and look at getting in when the price makes its first correction. But now, if you find this a little disconcerting, the fact that you still have circles and whiskers over here at the foot of your chart, and this is marked as only a 20-day cycle trough, then of course what you can do is you can start monitoring an analysis that actually has this trough marked as the 20-week cycle trough, because that will change ever so slightly the position of the FLD. Let's take a look at that quickly. Here you can see I've done a little bit of pinning, and there is the 20-week cycle trough pinned on the 31st of January. What that means is that this analysis is showing, confirmed at the foot of the chart, the analysis that I believe is actually in play. You can see that the 20-day FLD has been ever so slightly shifted. The 10-day FLD is in fact in the same place. So what are we expecting to happen now? Let me zoom out on this analysis, which I believe is the correct one. And let me display the composite model line, which is, of course, taking the cycle information from the analysis at the foot of the chart, the cycle wavelengths and the amplitudes. It is recomposing them, and it is showing the results of putting those cycles back together again in the past, and it's projecting that into the future. So what are we expecting to happen now? Well, of course, price at around about the time that the 20-day cycle trough is expected to form is probably going to dip down a little, maybe get a little closer, perhaps find support at the level of the 20-day FLD. Then we're expecting a bit of a peak to form. Then the 40-day cycle trough needs to form around about the beginning of March. Then we're going to experience another peak. Now, the composite model line shows a higher peak, but you must remember the composite model line is using information from the past. And as I've already mentioned in today's video, cycle wavelengths and amplitudes are dynamic. They are going to change. Hurst defined something called the principle of variation, which tells us that cycle wavelengths and their amplitudes are constantly varying. And so, although the composite model line confidently projects into the future, we must realize that these wavelengths and amplitudes are going to change. Is that going to be a higher peak? Well, it might be, or it might not be. The important thing is that we are expecting a peak in about early March. Then, of course, we have an 80-day cycle trough, which is expected to form around about the beginning of April. Then we're going to find another peak forming in the market. And then really the sort of bigger price move that we are expecting is something that I've mentioned before, which is that price needs to come down into this 18-month cycle trough. We have a very spread out nest of lows there, but we're expecting price to come down into that 18-month cycle trough, which is expected to form around about the middle of this year. So at the moment, the market is moving up. We're still in a bullish market. We haven't seen any signs of bearishness, but we are going to be looking for those signs of bearishness because the market does need to come down towards the middle of the year into an 18-month cycle trough. I do hope you found this market update interesting and useful. If you have any questions, please put them in the comments below the video. I look forward to hearing from you.